And speaking about the Fed in my very last video, quick look surprise, I'm about to speak about them again. More horrible decisions they've made with outcomes that we can expect, etc. Wolf Street has an article, Wolf Richter, buy, sell, or crash. Fed warns on stocks, and look what happens. If history is the guide, you're on your own. The Fed has planted 3 separate warnings on high stock prices into its March meeting minutes, released last week. In the past, the Fed has warned on various occasions on high stock prices with, let's say, mixed results. Stocks have crashed after warnings, and they've crashed without warnings, and they have soared after warnings. Perhaps the most infamous warning on stock prices was when Fed Chairman Alan Greenspan on December 5th, 1996, said in a speech that irrational exuberance has unduly escalated asset values. Stocks quaked in their boots for about one breath, then soared for another 3 years and 3 months before totally crashing. The dot-com bubble. So now we're getting a slew of Fed warnings. The most recent, 3 of them at once, were spread across the minutes of the March meeting. Broad equity price indexes rose further, leaving some standard measures of valuations above historical norms. Broad U.S. equity price indexes increased over the intermeeting period, and some measures of valuations, such as price-to-earnings ratios, rose further above historical norms, they said. A standard measure of the equity risk premium edged lower, declining into the lower quartile of its historical distribution of the previous 3 decades. And the third thing, many participants discussed the implications of the rise in equity prices, again stocks, over the past few months, with several of them citing it as contributing to an easing of financial conditions. A few participants attributed the recent equity price appreciation to expectations for corporate tax cuts, the tax cuts that may not actually be coming now from Trump, or to increased risk tolerance among investors rather than to expectations of stronger economic growth. Some participants viewed equity prices as quite high relative to standard valuation measures. And here is what Greenspan said. On that fateful December 5th, 1996 day, note the implications as he saw them for monetary policy. But how do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions as they have in Japan over the past decade? And how do we factor that assessment into monetary policy? We as central bankers need not be concerned if a collapsing financial asset bubble does not threaten to impair the real economy, its production, jobs, and price stability. Indeed, the sharp stock market break of 1987 had few negative consequences for the economy. But we should not underestimate or become complacent about the complexity of the interactions of asset markets and the economy. Thus, evaluating shifts in balance sheets generally and in asset prices particularly must be an integral part of the development of monetary policy. Upon Greenspan's warning, stocks barely wobbled long enough to notice before they skyrocketed into what would become the dot-com bubble and the dot-com crash 3 years and 3 months later. While Greenspan might not have worried about falling stock prices per se in his speech, he still got cold feet deep into the crash and radically lowered interest rates, thus kicking off the credit bubble that also contained a housing bubble and another one that you know of, auto loan bubble, all of which collapsed, and the current auto loan one is starting to collapse. So how did stocks behave after warnings from the Fed? This chart by John Alexander at Macro Charting shows the S&P 500 index going back to nearly early 1990s. The green dots signify Fed warnings on stock valuations. And let's take a peek at that. 96, right before the dot-com bubble burst. Immediately before it burst. This last one here, see that one? Goes down. on its way down. There's another issue. It's going to go down even harder. Now, this is the only exception, and it did go down just a hair right here. Just a hair right here before going even higher. 2008, oh my goodness, what happened? And now we have 1, 2, 3, into the foe. And we haven't had the real correction yet. This is a little mini blip here. 2015, nothing to see here. Could it be 3 years? Could they keep this puppy going for 3 more years? I gotta get the Magic 8 Ball out on this one. Magic 8 Ball. Can they keep this going and pump the stocks up for 3 more years? Outlook is good. Outlook good. Magic 8 Ball, you're fired. Outlook good. So anyway, sometimes it's a sell signal. Sometimes it's a buy signal, says John Alexander. And sometimes it's a crash signal. Well, we have 3 in a row. And it only went up a little bit more. So, wonder which one of those signals, right? So how long before the stock market hits the wall? Turns out it's actually overdue. But here's the thing. There's so much liquidity out there, supplied to this day by central banks around the world, that it would take some doing to get a crash going. In recent years, market participants have forgotten the lesson of the crash and have relearned the lesson of the bull market. Just buy the effing dip. When applied with enough enthusiasm by humans, and if enough trading algos have been programmed to do so, it stops the crash, at least for a while. Thus, it's unlikely that stocks can actually crash all in one fell swoop, as they did during the financial crisis. It's more likely that once they decide to head south, they'll work their way down gradually, frustratingly, and nervously, spread over years, not because of the Fed's warning, but because of the myriad lessons lurking around every corner, such as the ludicrously stretched valuations, the Fed's tightening, including the unwinding of QE starting later this year, supposedly, remember that? And unwinding of their balance sheet, and the bitter end of the credit cycle. There have been big red flags about the bitter end of the credit cycle. Commercial bankruptcy filings up from corporations to sole proprietorships soared 37% over the past 2 years. Read the Great Debt Unwind, Consumer Bankruptcies Jump First Since 2010, Commercial Bankruptcy Spike, which is on another article he has here. If you want to check that out, just check the link below in the description box. It is up to you. I cannot see how this is going to go on years. Oh, it'll just go even higher, higher, higher. There's just too much happening right now. The fact that I'm seeing the action in the Middle East picking up massively, which tells me we got to get back to the old Lindsey Williams thing agenda from his elite friend from circa 2011. 12, 13, 14, 15, 16, 17. 6 years, guys. We haven't overthrown that dude. We got to move forward. We've got to get this dealt with, or else we're going to be in big trouble. And it ends up leading to devaluation of the dollar, market crashes. Because he did say, Lindsey's friend did say too, when we're ready and this goes, anything you have that's written on a piece of paper that you thought was an asset won't be worth the paper that it was written on. That was his words, which means they do have to make this baby crash, and it's got to be big. It's got to be huge. So that's it. A little bit of a shorter video for you, but that's it. Take care.